everyone, my name is Wizard. I currently is an MBA student at UKM-GSB. So today I would like to present about the JetBlue Airways initial public offering valuations, IPO valuations. Okay, so we will see the company background. Okay, so for the company background, as we know that David Baggern is the former vice president of the Continental Airlines, and they are always making in one strategy, which is the fix everything that means that such as point-to-point service or lower cost per available seat, or try to provide the safe and other related to customer service, which means they are trying to improve their customer service. And then we also know that their position as in New York with 21 million potential customers, especially in the metropolitan area. They also have their competitors such as Southwest, Frontier, and WestJet. They also have concern about the issue with previous year, which is 87 new airline failure over the previous 20 years, and it also have involved net loss around 7.7 billion at the US airline industry. Okay, so next, the valuation approach, we are using two variations. For the first one is comparable company multiple, and second one is the discounted cash flow, which is the comparable is considered about the total capital multiple, EBIT multiple, price earning multiple. For the discounted cash flow, we will see the free cash flow, net present value, and the share price. Also the key assumption on the WACC, which is referred to cost of debt and cost of capital average. So the next one we will talk about the initial public offering advantage and the disadvantage. Okay, so IPO, for the advantage is that financial benefits in form of raising capital. When you are raising capital, then you can be fund on research and development, and also can involve the capital expenditure or paying off the existing debt by increase your capital. The next one is you can also increase the public awareness of company. Disadvantage is you will lose control corporate stock due to the more disclosure investor, and you also involve the higher cost accrued complying regulatory requirements. And the third one is you also have the constant pressure on analysis, which they have to show improvement in every quarterly. Next, we will see the price per earning multiple. Okay, the price earning for multiple, we can see how much the amount the investor invests in order to get $1. For the JetBlue, they have two airlines, which the first one is trailing and the second one is leading. For the first one, trailing is 28.83, and the second one for the leading is 34.12, which means the leading is the highest and the trailing is the lowest to get for investor to invest to get $1. Next, we are looking for the total capital multiple. So the total capital multiple, we will see is a one of the method valuation multiple. We can see the expression of market value of an asset relative to a key assumed relate to the values. Here we also have considered the price earnings and the book values per share and the dividend per share, then we come out the total capital multiples. Okay, we can see the JetBlue trailing 27.5. Next, we were talking about the EBIT multiple. The EBIT multiple is referred to financial ratio used to measure a company earning yield. Okay, so at here we can see the company earning yield for the JetBlue trailing is 16.54, but for the leading is 29.0x. Means the leading is more than the trailings. The next, we will see the discounted cash flow analysis. For the discounted cash flow analysis, first of all, we would like to determine the WACC, which is you need to calculate the cost of equity and the cost of debt in order to get the WACC. And in the same time, we also can calculate the free cash flow. And by using the WACC and the free cash flow, we also can determine the net present value, which is the negative 940.21. We also can see the share price, calculate the share price, which is 24.15. Next, we will see the summary overall comparable multiples. Okay, we can see overview for the price earning multiple, which is the highest for leading, and the total capital multiple only for the trailing around 27.5. But for the EBIT multiple is go for leading with higher value 29.08, but the trailing only 16.54. So we can calculate the average. So the average for the trailing is 24.31 and the leading is 29.18. So at here I would like to give a conclusion, which the stock price is 15.9, which means that the stock price is based on the case study I get 15.9, but after the initial public offering calculate the share price is around 24.35. So at here I would like to recommend the JetBlue share could offer the price level at 24.35 because to attract the shareholder to invest for the future performance. Conversely, if the stock, let's say the stock price is below the initial public offering price, it means that investors do not have any attraction towards your company. The solution is you have to raise your additional equity offering in order to get the attention from the investor. So I would like to say thank you for watching my video. That's all. Thank you.
Hi, I'm Aditya Mujumdar, an MBA student of UKM-GSB. Today I'm going to discuss about the Nike's case study. So let's start with the case background. In this Nike's case study, it says that Nike's negative financial performance during the year of 1997 to 2001 because of adverse effect of supply chain issue and the strong dollar. So Nike's management wants to communicate the strategy to revitalize their company by addressing some issues, and they want to improve by improving their top-line growth and operating performance, develop their mid-price footer and apparel lines, as well as they want to cut down their expenses. This case study is plotted from the view of an investor whose name is Kimi Ford. She is the portfolio manager of North Point Group. She wants to invest in Nike, but her stock valuation estimation shows that the Nike's current price is overvalued at $42.09, where the sensitivity analysis showed Nike was undervalued. So our aim of this case analysis is to find out the mistakes, give our solutions of that, and also provide the recommendations whether it was the right time to invest in Nike or to buy the shares of the Nikes or not. So before going to the stock valuations, we have to find out the WCC, because WCC is a very important element to do the discounted cash flows. What is WCC? WCC means weighted average cost of capital. It's a rate of return that could have been earned by putting the same money into a different investment with equal risk. Where WCC is the minimum return required by capital providers, and managers should invest only in projects that generates returns in excess of WCC. And it's set by the investors, not by the managers. So investors can only estimate it. Let's look about the case analysis issues, what we find about the issues in this case. At first is we have to find out that what are the cost measurement Nike use? Is this single cost or multiple cost? The answer is single cost. Though Nike have different brand and different business segments, but for the different brand or different business segments, they use the same business activities, and for each business segment they have same risk. At the same time, WCC is to value the cash flows for the entire firm. So single cost measurement is the right choice for them. Let's move to the cost debt. In the cost of debt, the mistakes they made is they use the historical data, which doesn't represent the future estimation of the cost of debt, and they also use the wrong method where they divided the interest expenses by the average balance of debt. So that's why they don't get the right current cost of debt. Let's move to the cost of equity. They use the CAPM, which is capital asset pricing model. They don't use DTM because Nike didn't pay their dividend to their shareholders from the year of 1997 to 2001. That's why they use the CAPM. This is the right choice. But they make the mistake is they use the historical data that not represent the future. So we have to find out the beta which represent the futures to represent the present or current cost of equity. Then the weighted average cost of capital, they wrongly use the book values as the basis for their debt and equity weights, where they should use the market value debt. Let's move to the cost of equity. They use the CAPM, which is capital asset pricing model. They don't use DTM because Nike didn't pay their dividend to their shareholders from the year of 1997 to 2001. That's why they use the CAPM. This is the right choice. But they make the mistake is they use the historical beta that not represent the future. So we have to find out the beta which represent the futures to represent the present or current cost of equity. Then the weighted average cost of capital, they wrongly use the book values as the basis for their debt and equity weights, where they should use the market values. Now let's look at the practical mistakes. Here we can see that cost of debt mistakes. We already said that they use the wrong method, and that's why they use the 4.3%, and they also use the historical beta that not reflect their current measurement of the cost of debt. Let's move to the corrections. Here we can use that YTM. We have to find out the YTM, so we can get the cost of debt. Yield to maturity. When we find out the yield to maturities are, we get the cost of debt is 7.16%. At the same time, when you find out the cost of debt, you have to understand, you have to consider the tax. So after tax cost of debt is stand as 4.44%, which is our real cost. Hi, I'm Aditya Mujumdar, an MBA student of UKM-GSB. Today I'm going to discuss about the Nike case study. So let's start with the case background. In this Nike case study, it says that Nike's negative financial performance during the year of 1997 to 2001 because of adverse effect of supply chain issue and the strong dollar. So Nike's management wants to communicate the strategy to revitalize their company by addressing some issues, and they want to improve by improving their top line growth and operating performance, develop their mid-price footer and apparel lines, as well as they want to cut down their expenses. This case study is plotted from the view of an investor whose name is Kimi Ford. She is the portfolio manager of North Point Group. She wants to invest in Nike, but her stock valuation estimation shows that the Nike's current price is overvalued at $42.09, where the sensitivity analysis showed Nike was undervalued. So our aim of this case analysis is to find out the mistakes, give our solutions of that, and also provide the recommendations whether it was the right time to invest in Nike or to buy the shares of the Nikes or not. So before going to the stock valuations, we have to find out the WCC, because WCC is a very important element to do the discounted cash flows. What is WCC? WCC means weighted average cost of capital. It's a rate of return that could have been earned by putting the same money into a different investment with equal risk. Where WCC is the minimum return required by capital providers, and managers should invest only in projects that generates returns in excess of WCC, and it's set by the investors, not by the managers. So investors can only estimate it. Let's look about the case analysis issues, what we find about the issues in this case. At first is, we have to find out that what are the cost measurement Nike use? Is this single cost or multiple cost? The answer is single cost. Though Nike have different brand and different business segments, but for the different brand or different business segments, they use the same business activities, and for each business segment they have same risk. At the same time, WCC is to value the cash flows for the entire firm. So single cost measurement is the right choice for them. Let's move to the cost of debt. In the cost of debt, the mistakes they made is they use the historical data which doesn't represent the future estimation of the cost of debt, and they also use the wrong method where they divided the interest expenses by the average balance of debt. So that's why they don't get the right current cost of debt. Let's move to the cost of equity. They use the CAPM, which is capital asset pricing model. They don't use DTM because Nike didn't pay their dividend to their shareholders from the year of 1997 to 2001. That's why they use the CAPM. This is the right choice. But they make the mistake is they use the historical beta that not represent the future. So we have to find out the beta which represent the futures to represent the present or current cost of equity. Then the weighted average cost of capital, they wrongly use the book values as the basis for their debt and equity weights, where they should use the market values. Now let's look at the practical mistakes. Here we can see that cost of debt mistakes. We already said that they use the wrong method, and that's why they use the 4.3%, and they also use the historical beta that not reflect their current measurement of the cost of debt. So let's move to the corrections. Here we can use that YTM. We have to find out the YTM, so we can get the cost of debt. Yield to maturity, when we find out the yield to maturities are, we get the cost of debt is 7.16%. At the same time, when you find out the cost of debt, you have to understand, you have to consider the tax. So after tax cost of debt is stand as 4.44%, which is our real cost of debt. Now let's move to the cost of equity. Their mistakes that they take the average historical beta, which is 0.80. This is not the representative of the futures. So that's why we choose the most recent beta, which is 30 June 2001, 0.69. And we find out the cost of equity is 9.81%, while it was before 10.46%. Now let's look about the weighted average cost of capital. Here we find out the market value weight for equity is 89.90%, while weight of debt is 10.1%. At the same time, in our previous slides, we already find out that our cost of equity and cost of debt. So now it's easy for us to implement our findings into the formula, and we get 9.27% as a CC. Let's move to the discounted cash flows. What the discounted cash flow says. In the discounted cash flow, it says that in the WCC of 9.27%, their equity value or intrinsic value per share is $58.13, while the current share price is $42.09, which means it's undervalued. So let's move our recommendations. We will recommend to the Kimi Ford to buy the shares of Nike because it's undervalued, and while it's undervalued, the investors have to invest very less than when it compared with the overvalued. At the same time, in future have the probability to increase their NPV or net present value. At the same time, they can get the high equity. So we will recommend for the Kimi Ford to invest or to buy the shares of Nike. So that's all from me. Thank you.
Hello, I'm Jessica, the master student of UKM-GSB. Today I would like to talk about the WM Weekly GR Company, the capital structure, valuation, and cost of capital case study. In this case, it discussed that due to the low interest rates, Aurora Borealis LLC is suggesting Weekly to take on $3 billion in debt and use it to pay equivalent dividend or to repurchase an equivalent value of shares. First, the impact on the share value. The value of the firm has increased. The value of equity dropped after the recapitalizations. Therefore, once the investors know the recapitalization will occur, the share price will increase immediately to a level that reflects the $1.3 billion value of the interest tax sale. Next, the impact on the debt rating. From this case, it will drop from AAA to BB and B with the leverage of $3 billion debt by Weekly. Although the EBIT interest coverage of greater than 1, which is 1.32, showing that the company managed to fulfill the obligations. But the drop of rating will give negative impressions to the investor as well as the limit company financial flexibility. Next, the impact on the WACC. It saw only a minor increase in cost of capital, which is 10.90% before and 10.91% after recapitalization. It indicates that it's very insignificant, which may due to relatively low debt to equity ratio of weekly, which is around 26% after recapitalization, and also the limitations of Hamada equations to reflect the incorporate default risk, which in this case is financial distress due to over-leverage. For the earnings per share, shareholders will experience a decrease in earnings per share under all three growth scenarios with the issuance of $3 billion in debt. The share repurchase scenario results in higher earnings per share than the dividend-based recapitalization test due to the decrease in shares outstanding. Next, the impact on voting control. The dilution of common shares will improve weekly family voting control position from 46.6% to 48.8%. This is because large holding of Class B common stock by the family, which carries 10 votes per share. Voting control compositions had very little changes, as the controlling level remains almost the same before and after recapitalizations. For the conclusions, due to large asset value carried by weekly, the cost of financial distress bears a low cost and can be ignored. In terms of WACC, there is no significant changes before and after the recapitalizations. This may due to the tax sale which offset the higher cost of equity and almost negligible cost of financial distress. The signaling impact only gives a short-term impact on the stock value, but over time it will not play any significant role. The increase in leverage and cash return to investors will give the positive signal to. In recommendation, I will recommend weekly to take on the $3 billion in debt. This because from the analysis, tax benefit of using more debt were virtually offset by the higher cost of equity. I also suggest that weekly should choose to repurchase the shares but remain in the same dividend payout because it will create more value for shareholders. The increase in value of company will increase the market shares. Furthermore, the stock repurchase will give benefit to weekly, such as more flexibility, offset to dilutions, repurchase as investment, tax advantage, and executive compensation.
Thank you.